Hello, investors. Welcome to Monthly Interaction with Canara Robeco. Let us go through how the last month and last few months have been in terms of the global domestic macro, and then how we are actually looking at the equity market. On the global front, clearly, a tariff has been the issue which has been at the forefront for last few months, and it continues to do so. Latest on that being one of the court in US actually putting kind of in a way indicating that the tariffs are unconstitutional and putting a hold on them. Of course, I don't think we have seen the end of it. We will have probably further to and fro on this. But more importantly, how do we look at the entire tariff saga? And we have been discussing this for several months now. Is that our sense is this tariff-related uncertainty and some of the other geopolitical uncertainties have three key takeaways for the markets, for the economies globally, and particularly more so for the equity investors. One is clearly we are operating in an environment where there is going to be volatility and complexity, and when there is so much of uncertainty related to how the supply chains and value chains which have been developed over last 30 years are going to function in future, uh, natural course of action would be that the corporates investors would be putting their investment decision in a base, which means you're going to have trade impact, you're going to have growth impact. And so the first key takeaway from this entire saga, and which is likely to be witnessed by the world over next few quarters, is growth slowdown as an outcome of the tariff complexity that has come to fore. That is one. Second is basically how it is likely to play out in US in terms of the bond markets. Clearly, it looks like, given that the amount of debt that they have, every time there is a issue around tariffs and there is a noise around tariff and there are more complexities around tariff, you're going to have basically the global investors, central bankers, and others effectively selling US Treasury, which means higher yields in US, which makes the job of US government further complex. And that's where our thesis right from the beginning on this issue has been that probably you'll start with a tariff negotiations at very high level, and eventually probably most of the countries will settle it between 10 to 25%. So that's second. So first, clearly you are going to have growth impact. Second, probably will settle at between 10 to 25%. We have not seen the end of the tariff-related issue. Third is, as an outcome of all these things, the global commodity prices will remain benign, and that's what you are seeing in most of the commodities. Oil at one point and came below 60, now again at 65. Most of the other commodities, except the precious metals, which is a play on uncertainty, has actually seen a southward bias. That's third. And lastly, and which is the only silver lining that we see out of this entire uncertainty, which is a man-made uncertainty effectively created by US on tariff side, is that when a large country like US, where the market capitalization of US as a percentage of globe is more than half, the outstanding equity and debt holding of global investors in US is so high, US is behaving like an emerging market whereby there is so much of uncertainty. So uh, the outcome, most likely outcome, is the capital allocators globally, including the central bankers on debt side, the private capital which has gone into US, all of those guys, the institutional investors, have to think whether they continue to have that kind of allocation in US. And thus there is likely to be a tectonic shift in what we have seen over last 15 years versus that. Over last 15 years, one way you have seen the capital typically both in equity and debt flowing towards US, and global investors flocking towards US, because US was a market where there was higher growth, there was a superior earnings growth, there was superior corporate governance, there was a policy stability. All of that at least initially seems to be coming under question, and that's where all this capital which is sitting in US has to think about uh, whether they want to have that kind of capital allocation in US. And that's where we think that all the rest of the developed world, including Europe, Japan, Australia, other developed markets, as well as all the emerging markets, could be beneficiary of this situation, whereby the capital allocators are actually thinking about moving capital away from US and towards the rest of the world, including India. If we actually get our growth in place, I think we will also receive a very, very large capital inflow. And that's the silver lining of this entire situation, whereby for the first time, the capital has to actually look for, large capital bases have to look for choices away from US, and India being among the top 5 economies could be one of that destination. And that's where this possibility that what we are not seen in last 5 years in India, whereby we are not received any FII flows, we might end up actually receiving FII flow. Of course, it is contingent on corporate earnings growth and how they play out, and GDP growth rate, how it plays out. So we need a earnings growth which moves to double digits. So we'll evaluate it in the second part of the discussion. But this is the first part. Global macro remains complex. Tariff related uncertainty is not over. It will have its own growth impact. Our sense is eventually tariffs will settle in between 10 and 25% with most of the countries, mostly friendly countries, probably 10-15%. Hostile countries, China, probably toward the higher end. And lastly, the silver lining of this entire thing is the global capital allocators like Japanese guys, European guys, rest of the guys have to start thinking, where do they allocate the capital? Do they move away the capital from US to the other emerging markets and developed markets? And India could be one of the beneficiaries of that. So that's the global context, not so bright, but very interesting from capital flows perspective as to how they play out over next 1 year. Coming to the domestic piece, I think domestic macro has remained very, very stable. I think India has been almost a hallmark of stability over last few years in terms of macroeconomic stability. We have not done any excesses. Our fiscal deficit is moving under control. The current account deficit remains under control. The banking system remains fairly healthy. The real estate and private balance sheets remain extremely healthy. Your inflation probably is among the lowest that we have seen lately, which is likely to allow the central banker to cut interest rates very, very aggressively or fairly aggressively from here on. We're expecting another 50 to 75 basis point of cuts over next 9 months, given where the CPI inflation is at about 3.2 to 3.5%. So when we look at the combination of all these things, macroeconomic stability and macro stability or macro health remains in almost a pristine league. The challenge has been contextually on the growth side, and which we have debated in the past interactions also. The challenge has been that predominantly because of two reasons. Of course, there are multiple reasons, but financially at 25 witnessed a downgrade in GDP growth rate and a downgrade in basically earnings growth rate, predominantly because of two key reasons. One reason was basically government's capex during election actually moving down from plus 20-30% to minus 20-30% in a span of 4 quarters. So that slump led to, in a way, shock to the growth at the margin. Second, of course, was parallelly at the same time, central bankers' policies, both administrative policies as well as external currency policies, led to two things. One, a slowdown in the unsecured piece of the credit, as well as a liquidity environment which was extremely tight. Combination of these two things, along with a very, very high monsoon last year and on some of the other reasons, you led to basically earnings growth falling to 5%, 6% in financial year 25 from a healthy 25% when I look at Nifty in financial year 24. So financial year 24 was 25% earnings growth. Financial year 25 has turned out to be 5-7% earnings growth. And the reason has been, as I said, two reasons critically: the tight liquidity and a credit slowdown towards the unsecured credit card SME piece of the market. And on the other hand, the government capex slowing down. Our belief is both these factors are contextual, they are cyclical, there are no structural issues with the economy. And that's where our belief that basically this contextual issues will go out, and actually they are going out, and it is already visible in this quarterly earnings, and I'll come to that in a bit. But when your balance sheets are not a challenge, and there are contextual points like these two, as they resolve themselves, your earnings growth will move back to nominal GDP growth rate plus, and that's what you are already witnessing and likely to witness for next 3-4 quarters. That as these issues where government capex has come back to 10-12% now post the election late slowdown, the RBI policies have reversed, the domestic liquidity is in surplus, the monetary policy is likely to come to fore, where 3 quarters back, if you had asked, we were saying probably 50 basis point of interest rate cuts. Now, point to point, we might experience 100 to 125 basis point of interest rate cut from top to bottom, which is a deep interest rate cut cycle. All these things are likely to lead to a normalization of earnings growth, a normalization of GDP growth rate. And as that happens, you should experience these earnings growth, which are slowed down in financial year 25 to mid-single digit for Nifty, negative for small caps, and probably a little higher, the low double digit in for mid caps, likely to reverse back to a normalized level as these contextual issues go out, and they have been going out already. The RBI policy has changed significantly in terms of liquidity as well as the credit towards some of these unsecured pieces. Also, the government capex has come back. Private capex continues to grow at 10%. Real estate continues to be in good health. The banking system continues to be in good health. Private consumption is an additional factor uh, which is likely to be a beneficiary of what the state central government policies have been lately. Our assessment is anywhere between 3 to 4 lakh crore rupees of additional money is going towards the uh, mass rural and mass urban poor. And as that happens, you will see a little bit of a pickup in private consumption as well. So, combination of all these things, growth cyclicality will turn more positive than negative, which was the key characteristics of financial year 25. When we look at even the latest quarter, that's exactly what we are experiencing. The earnings growth estimate beat versus the or upgrades versus the downgrades. The ratio this quarter has been good. Uh, Nifty or large caps have delivered largely because almost you're at the end of the result season. Large caps have delivered 7-8% earnings growth. Mid caps have delivered mid double digit, mid teens. Whereas the small caps is the only piece where the earnings still remain fairly weak, where the small caps have delivered negative earnings growth. The key is where we started the fourth quarter financial year expectations and where we have ended in terms of how the earnings have played out. There are more beats. It has been relatively better than what was anticipated. That's where I said there was a cyclical, basically slowdown because of certain factors that is gradually being actually taken out as you go through next few quarters, and that's where our kind of hope and estimate that you will go into low double digit earnings growth as you go through financially 26 and 27. That's where the earnings is. Clearly, the earnings have been better than this fourth quarter, except for small caps, where we still feel that the earnings have been fairly weak. Earnings YOY basis for the entire financial year 25 and for the fourth quarter have been negative in negative territory. Mid caps have been the best, then large caps, and then the small caps in terms of the earnings delivery that has happened this quarter. So, that's what the earnings picture looks like. To summarize, very weak financial year 25, but recovering financial year 26 and 27 in terms of its expectations, going to probably low double digit, low teens kind of numbers, which is the consensus number for financial year 26, 27. I think those numbers are likely to get met. So now coming to the valuations, I think as an outcome of the India-Pakistan short-lived war, as well as these tariff-related issues, you had a deep correction, you had froth taken out, but quickly as market realized that the earnings are not that bad and these events are out of picture, the market quickly recovered back almost 13 to 15% point to point based on what part of the market you are looking at. I think market has come back to fair valuation zone. The large caps are trading at roughly 20 times 1 year forward earnings growth. The mid caps are trading at 25, 26 times 1 year forward earnings growth, and the small caps are trading at 23, 24 times 1 year forward earnings growth. So, when we look at these valuations, most of them from their historical context now have already come back to fair valuation zone. So, from a valuation perspective, we are clearly in a fair valuation zone. The worries are over, and in terms of earnings as well as the geopolitics are largely over, and it has reflected in the market. Our sense is incrementally, while the market is in a fair valuation zone, market is likely to more consolidate. And since the valuation post this 13 to 15% up move has come back in fair to expensive valuation zone, for example, for large caps in fair value zone, whereas for mid and small cap again in the relatively expensive zone, we expect the consolidation in market for coming quarters till the time earnings growth uh, uh, start actually surprising from the consensus expectations. That's how we are looking at the market in terms of the portfolios. This is a market which is far more bottom up. But having said that, from a sectoral perspective, financials, NBFCs, capital market plays, hospitals, hotels, industrials, select industrials like transmission and renewable, defense, telecom, pharma, and consumer discretionary. These are the spaces where our portfolios on an aggregate basis remain overweight. As a house, we are underweight on IT, the metals, as well as oil and gas. So that's the portfolio positioning. So just to summarize, a complex macro, uh, but the expectation of FIF low as we get our growth back. A domestic macro which is extremely strong, a domestic growth which has gone through a cyclical downturn in financial year 25, but recovering in financial year 2026, 27. And within that, a market consolidation given the quick pace at which the market has come back. This is the summary of what we spoke today. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.